Good afternoon, everyone, and welcome to Park Edge Advisors Market Insights for October 2025. My name is Matt Gordillo, co-founder, financial advisor, and I'm joined by Gavin Gowecki, a portfolio manager, and Rich Lowry, our partner and chief investment officer as well. Welcome, gentlemen.
Hi, Matt.
Hey, Matt.
Before we begin, just a quick word from our sponsors. Very good. Thank you, Gavin. Thank you, Rich, for joining us. And as always, Gavin, why don't you provide us an update from last month?
Sure. Last month we discussed we were in the balance between a quad 1 and a quad 2. To remember we are in a risk on market regime. At this point, you'll see on the Market Insights PDF for clients that are looking at that we still are in quad 1 technically, but our view outlook ahead is actually for a quad 2 growth higher, inflation higher type of a backdrop. So not a ton has changed month over month, but that's kind of where the roadmap is pointing at the moment.
Anything to add, Rich?
Yeah, I would just say we're going through this U-shaped economy that's poised to take off in the first half of 26. It looks like consensus growth estimates have bottomed and are starting to come up. The quad 2 that we see is really based on the reacceleration of growth we'll see in the first half of next year. And because consensus estimates are lower than ours for the fourth quarter, as they revise estimates up, consensus may see that as, growth reaccelerating, and that could give a quad 2 flavor to it. And, quad 1 and quad 2 are both risk on. But when you look out in the first half of next year, we're going to see meaningful fiscal stimulus in the form of tax cuts. The impact of deregulation should show up in increased bank lending. That looks poised to pick up. And then liquidity looks to be strong in the first half. So I think for investors, you want to be mindful of the fact that the first half of next year looks bullish. And it's a matter of, we've seen hiccups in private credit, major bankruptcy with First Brands. There could be some bumps along the road between now and the first half of next year. But for the most part, those would look like buying opportunities to us.
Well, that sounds like great news. We always like bullish news and bullish outlooks, so that's great. We're here now at the quarter end or quarter begin, however you look at it. And I thought we could take a different approach and highlight, times have been good. Obviously, the summer months with positive returns for the equity markets and fixed income. And, so clients are out there feeling good about themselves. Portfolios have increased in values. And now more than ever, it's probably a good time to keep in mind good, sound fundamental principles, diversification, asset allocation, et cetera. So I thought maybe, Rich, you could share with us just a little bit of a kind of a rundown and maybe highlight one of our strategies and something new that we're rolling out for our clients. And so we could kind of tease it to them a little bit today. And you can add your comments about this particular strategy, because I think it is a good all-weather strategy in good times and in bad. But I'll turn it over to you, and you can kind of share your thoughts on this macro persist strategy. And I think it has some visuals for us as well.
Yeah, well, I think, first of all, we want Park Edge to be differentiated in the marketplace on our ability to manage risk actively. So relative to the standard 60-40 buy and hold in the industry, that rests on a premise that risk and return are positively correlated, and that relationship is constant. So in other words, risk is the same every day you wake up in the morning, and that's not the case. We know that risk clusters in quad 3 and quad 4. So what we want to be able to do is manage that risk actively. And risk on markets take more risk where you get paid for it, and risk off markets reduce risk where you don't get paid to take risk. And from there, we've developed a suite of strategies that all rely on the same basic framework, but have triggering mechanisms that have different degrees of sensitivity. So, if you think of this in phases, in our former selves, we used to be 60-40 buy and hold just like everybody else. That transitioned into, say, a sleeve or an allocation to something that was, more tactical. That led to a full strategy, our all asset strategy, that can invest in any asset. It can actively manage risk. And then that's evolved into a handful of other strategies that also manage risk actively, where now the message is to diversify by signal. So the traditional philosophy on diversification is to have some in stocks and some in bonds. That's your 60-40 portfolio. But those correlations have been breaking down. They broke down in 2022 when people needed them the most. They weren't there. We're in this fourth turning financial repression, monetary debasement phase. And I don't think investors can rely on that, traditional correlation. So when we think of diversification, it's not a mix of stocks and bonds. It's diversification by signal that generates the active risk management. So, what we would like to do is get one-page fact sheets together on all these strategies. In future sessions, maybe we profile, a different strategy, but they would be available, for rollout for all clients. So the one we wanted to go through today, this is I would consider a first draft. And this is our macro persist strategy. Macro in the name means that it is looking at broad macro factors to determine risk on, risk off. The persist is a method of assessing trend persistence that is unique to Park Edge. Gavin actually developed it. So Gavin, why don't you walk through macro persist?
Sure.
And maybe hit some of the highlights on it.
Yeah, and some clients will be familiar with this strategy. It can be used standalone as a total solution, but most commonly we would blend this with other strategies that Rich mentioned. And one of the benefits there is that you get multi kind of factor and duration across timelines, which you'll see in a second, we think helps increase risk-adjusted return. Basically, this is a modern alternative to the 60 equity, 40 bond allocation that Rich mentioned. And it doesn't, necessarily move completely away from equities and bonds. It just also incorporates commodities and currencies. So when you bring the four major asset classes together, equities, bonds, or fixed income, currencies, and commodities, and take that total opportunity set, we find that we can better position through growth, inflation, and policy shifts and changing market conditions. What we're thinking for these one-page fact sheets would be just, this is cumulative return, which is only so helpful, because it isolates one kind of point in time, but still we show it here as a proof of kind of concept of what we're doing. These are annualized returns down here, which are more helpful. But then the most important thing, echoing what Rich first alluded to, is none of these return numbers mean anything to us at Park Edge without the risk information. And I guess not to get too into the weeds, but the one takeaway I would want people to notice here is that, and this is not just true for macro persist, it's true for other strategies that we have as well, is that you'll notice the 5-year beta, which is the equity beta, which is how similar or, dependent on returns from stocks or the S&P 500 going higher. How dependent is that? And you can see it's 0.05, which is very low to negligible. And that's the takeaway that's important. Going back to Rich's point, it's really combining different strategies together that are not all correlated. And that's one of the pillars that we focus on here at Park Edge. So did you have questions, Matt, or?
I would just add a
Go
couple
ahead,
of things. Couple of things I like about it is, it's an all asset portfolio, and it can hedge. So in 2022, the bond piece, it's always going to have something in stocks, something in commodities, something in currencies, and something in bonds. But in 2022, for example, it wasn't trapped in being long of bonds. It hedged and actually made money from bonds going down. And then this year, the best performer most likely has been the currency piece, which is occupied by gold. So having the ability to invest in all assets, is part of why the risk-adjusted returns are good. But also the ability to hedge where, you're not trapped in going down with the ship. If it's a bear market for that particular asset, has the ability to hedge and try to be opportunistic in that kind of environment.
Gavin, what would this portfolio benchmark against for our clients out there?
Sure. We have it here as the benchmark you're seeing here is actually the Vanguard Life Strategy Moderate Growth Fund. Benchmarks are tricky for a strategy like this because, traditionally someone would look at this and say this would be more of an alternative. But at Park Edge, we're rewinding and saying, well, wait a second, why should we, like Rich said, be locked into only stocks and bonds? So we're a bit different in that sense. Where it's important for people to why we do have a benchmark here is that we still are dialed into the risk profile. And so this would slot as a moderate risk. Everything is sized to meet that type of risk assessment need. And so that's why we still have it there to show, what an alternative would be like for a moderate risk.
That's terrific. So as always, we're always looking to get risk-adjusted returns at Park Edge, and we've just done a terrific job of that lately. And maybe more to come, but that's why I maybe in closing, Rich or Gavin, what should we look forward to, coming out of this month's market insights? And that was an excellent update on just one of our strategies, but what should we look forward to going forward?
I'll start with that. A positive first half of the year, growth picking up, benefits from tax cuts, benefits from deregulation, positive liquidity. So the base case is bullish in the first half. For any base case that we ever have, there's always what we call a right tail, meaning a more positive outcome. What could happen to make it even better, and also a left tail. What could go wrong? What would the bearish scenario look like? So taking that as a base case, the right tail would be that you start to see some meaningful improvements from AI, translate into productivity gains for the users of AI. So right now the AI theme has been, on kind of the builders of it, who's providing the picks and shovels to the AI, infrastructure. The next phase is, do we see a pickup in productivity? And that could be a meaningful positive that I don't think is, incorporated in anybody's, growth outlook. The left tail kind of the bearish scenario that is out there. And if it looks like it materializes, we think our signals will pick up on it. But it just goes back to what we've talked about prior, which is the government has 11 trillion of debt to sell. The price insensitive buyers of treasuries aren't buying anymore. The Fed's not buying, they're selling. Foreign central banks aren't buying, they're selling. Commercial banks are up to their eyeballs in underwater bonds pre 2022. They're not buying. It's been up to private sector buyers to pick up the slack. And there's a limit to, how many bonds private sector investors want to own. And if the correlations stay broken, that provides a further limit on it. And the US's net international investment position, which measures how much US assets are held by foreigners, less foreign assets held by Americans, is negative 26 trillion. So, going forward, we're going to have to sell more debt to finance a deficit and refinance old debt. And there just aren't a lot of buyers for it. So, the bearish scenario would likely revolve around troubles in the bond market. We're not seeing signs of that currently, but at any moment in time, we have kind of our base case. What could make the base case even better? That's the right tail. What could derail the base case and make it bearish? But for the most part, we're looking forward to a positive first half. Likely to be a road bomb between now and then. It's been a while since the market has had any kind of pullback, so one could be out there. And then we continue to monitor the Treasury net financing position, and we'll track that as kind of the left tail scenario.
Very good. Do you have anything to add?
I think next time, maybe we could do a quick update on earnings season, which is going to kick off next week. And I mean, on the portfolio side, for me, that's going to be my focus to see. I think it was a fairly good season last year, last quarter. Can earnings momentum sustain this kind of pace? And it's becoming increasingly clear it's a narrowing kind of leadership of this AI narrative. We wrote about that in the core stock note. If listeners want to check that out as well. So maybe, come November, we can talk about, hey, how are things looking? Because that's something to kind of keep an eye on.
Very good. Gentlemen, thank you. Very informative. Lots of exciting information, new stuff to roll out, and things to look forward to for next month too, and then beyond. So we'll talk to you next month.
All right. Thanks, Matt.
Thanks.
Have a good one.